Welcome to our live session today. Right. So my name is Jia Xuan. I'm one of the community managers in Goodwill, and today we'll be covering some of the updates about whatever that's happening in the past week. In fact, last Friday, right? Today is Tuesday, so not a lot of, not a very little news, but hey, yes, yeah. So Eric is on the YouTube site just testing things out, and yeah, one of the things, maybe I can share a little bit about me for those of you who have not seen me before. Yeah, I actually came from the science background, but things changed, adulting happened, but I became more, how do I say it? Became more interested about the finance side of things, and that led me to explore this space, and then I've been like investing for I think close to 3 to 4 years already. Yeah. So, anyways, I'm just an investor just like you, and I think this whole investing journey is nothing but a learning journey for me, as well as the amazing people in our community members as well. Oh, Eric and Wolf, nice. Right. Two things we'll be covering today. Right. Two things. Right. So the first part will be market updates, where we'll be talking about what happened over the weekend and what is this whole change in terms of the ratings. Yeah, we go through that. Right. So that's on part one. The part two will be more of a closed door session with our community members in Wealth Pulse, right? So Wealth Pulse is our weekly sharings about the market updates, and that's where we'll go through about companies, news, and any opportunities that we see. But more importantly, is to have the habit of coming together every single week to get to learn a little bit more about the markets as well as some companies, right? So the main goal is to form this habit of doing things together, so that in any case something bad were to happen or the stock market crash like just a while back, right, at least we still have this close community that we stay together and stay sane and keep each other in checks before we do any irrational decisions, right? So that's the main goal of Wealth Pulse, and that's what it's all about, right? For those of you who are tuning on Wealth on YouTube, right, if you'd like to join the community, there's a link in the description box below, so just click on it and then you will have a 1 month complimentary access to Wealth Pulse, right? So let me just quickly go over to my community at Goodwill. So this is where we will be hosting our Wealth Pulse for our community members. So there's a base camp, and of course there is a Wealth Pulse space, right? So you can see that this one is a US $9.90 per month, and under exclusive, that's where we have our recordings. Let me just zoom in for you. Nice. All right, so over here, these are all the recordings we have. And then I just realized one of the sessions that me and Eric couldn't make it, I actually recorded a session regarding a company that I was interested in. And at that point of time, when I was like looking in this company, I didn't enter. But recent times, because I had some updates about it, and then I went to find a little bit more and enter a little position. So what is this company? I will direct you to this particular video. This one, on the 4th of March. So if you have not watched it, go and watch it because the numbers are great. So, like, the gross profit margin is over 90+%. The net profit margins is also, I think, close to more than 60%. So do check it out. The numbers are quite pretty. And then so regarding this, their earnings report actually came out a while back, like 1 to 2 weeks ago. I have recorded it. I will upload it tonight. Okay, tonight there's a new two videos that will be uploaded on maybe tomorrow. Yeah. But anyways, there will be 2 videos uploaded tonight or tomorrow. And that's where you check it out over here. And of course, for people who are tuning in live, you can go to events page and then click on to the upcoming one. So today we are in this one. So if you're in the Zoom chat, you are inside. For those of you who are in YouTube, right? So this is how to navigate in our community. Mainly we'll be using Zoom as well as our WhatsApp. Okay, but anyways, let me jump back straight into it, to this session, and we'll just quickly launch a poll in our Zoom just to find out a little bit about how is everyone feeling right now. So this is something that we do every single week if you have been coming back, just to check in with you, where you're coming from and how do you feel about the market. And yeah, how do you feel about the last week if you have joined us? Okay, so other than that, right, so just help me to click in the poll. Yes. Anyway, so if you have any friends who are new to investing or about to or already entered, just that they don't know what to do or they need a community to support each other and they don't mind Goodwill as a solution or like a community that they can join, yeah, do share them the socials and also the 1 month complimentary link to your friends so that they can join in as well. Okay, right. So nice. I think some of you are still on the way home and then you are unable to click into it. But anyways, just some small little updates before about myself before I go into the session itself is that recently also last week Eric had some health issues, right? So this week itself, it was me lah. So I had some, I don't know, is it stomach flu, like food poisoning, but yeah, had a very unpleasant weekend. Yeah, so again, so just want to emphasize while we are here learning about investing and growing our portfolio, let's not forget about our health portfolio as well. Yeah, staying healthy, eating safely, and eating good food. I think that is also very important, right? Yeah. It's never good to spend your weekends in the toilet. Yeah, it's 2 weeks ago for Eric. Yeah. Oh, I'm talking, Eric. Yeah, anyways, yeah, just some quick updates about what we have gone through. And this is just 20th of May. But look at the amount of things that we have covered for the past, from January until now. We've covered at least, let's say, 5, 15, around 17? No, 18 to 19 already. So I'm just amazed by the progress that we have. And then for all of you wonderful, amazing community members here that have journeyed together, you have seen all these things that you have been doing for the past few months. And so just wanted to give yourself a round of applause and also give you a thumbs up for staying true and also learning something new about the market every single week. All right, great, nice. You need to rest for nice. It was a weekly since the beginning of the year. Yes, that's right. Oh, I'm looking at the YouTube as well. Okay, that's something I need to accustom to. Okay, so let me just look at the chat, the poll. Okay, so some of you are feeling that it's greedy. A few of you are feeling that the market is very fearful, probably because of the recent news about the downgrading of this credit scoring of US stuff, right? So who knows? But anyways, yeah. So let's look at the market. And one of the ways that we like to check the market is S&P 500, and that is where we look at the fear and greed index. So if you don't know what fear and greed index is, basically it's a meter that tells you how greedy or how fearful in terms of the market is in terms of S&P 500. So you can see that when the market is very fearful, right, share price or the ETF price of S&P 500 usually goes down, right? And then when it recovers back up, which is just a few weeks ago, right, the fear and greed index actually became more and more greedy. And this week itself, it is on the very even more greedy side. Last week was like greedy at 62 scoring. This week itself is like a 70%, what do you call it? 70%, but 70 out of 100. Okay. I think the market continued to rally up because of the good news regarding the China as well as US tariff pause. So I think last week Eric talked a little bit about this. And then yes, yeah, good news for everyone that participated in some of your and scoop up some of your beloved companies. One thing that we are doing here in Wealth Pulse in Goodwill is that we are asking or having our community members to select or filter out the 5 companies that they would like to focus on. And the reason for 5 companies is because that we are retail investors, right? The likelihood of us having a very big portfolio like Ray Dalio, Warren Buffett, and all the big players, right, is that we don't have a lot of funds. So when we don't have a lot of funds, we still need to diversify, just that the amount we can diversify is limited as per our lifestyles as well as the amount of time we want to spend on investing. That's why having our top 5 ready to go and ready to enter more positions is something that I think as investors, it's always good to have this watch list, this target board, so that when the time comes, like when the market have crashed here, that opportunities have arisen. Without further ado, don't need to go and look too much or consider like which one or which stock should I enter. Now with this 5, that I just need to select from 5 instead of the whole full list of 20, 100 or even 200 over companies in the watch list, right? So that is the main goal of this 5 holdings to watch out for, right? Yep. So for me, I entered a little bit, and then I think previously I will talk about this in the closed committee because we're talking about some number stuff, money stuff. So just to be on the safe side, we're doing it closed door in our Wealth Pulse second part of the session. So if you're interested, of course, you can go and claim the link if you've not done so, and then you can join us in the Zoom, right? So that's where we'll talk about the second part, which is more on some of my personal updates as well as the findings that I have regarding Nvidia. Oh, okay. So Nvidia recently also announced that they have not really announced, they actually participated in the Computex 2025. So this is an iconic event that is held in Taiwan every single year so far that I know. Right. Also a lot of updates, and that is where, as a fellow Nvidia investor, I think that's where you can get, or I can get some insights about it, which I would like to share with you in the second part of the segment. Anyways, today's main topic is still coming back to the market updates about what happened over the Friday or over the weekend, right? So I think this is something that is creating a lot of interesting take on the social media platforms. And like today, we would like to explore deeper into finding out or understanding what is this about? Is this a big issue? And obviously, as investors, what are some of the things that we need to take note of about this, right? Is it a red flag for us that US is not doing well? Back to, I think, was it Shilin was saying that, oh, when the market crash, we should invest in the US. But now that this news is out, oh, the safe rating about this AAA is down the drain. Is this something a big issue? We'll go into it deeper. Okay, but firstly, what caused Moody to actually downgrade this? Actually, Moody is not the only one. There's three other rating companies, right? One is S&P 500, S&P, sorry, not S&P 500, S&P, and Moody is one of the other ones. And Moody was one of the last ones to like downgrade. They held on this AAA rating for super long. I think for S&P, they downgraded it in like 2011, if I recall correctly. But yeah, Moody followed by the second one, and lastly, finally, 2025, Moody finally says that, hey, your US AAA rating no, it's not. It's no longer AAA. Yeah, so this is the highest of the highest rating. So meaning to say, if your rating or this asset class is on the AAA rating, right, it means it's the highest. And by being the highest, it kind of means that you have the lowest risk, right? So having a AAA rating means that you are one of the low risk, or if not, they term it as the risk-free kind of like asset class or asset tool that you can keep your money safely, right? But now that it's downgraded, oh, there's different takes. And I also have my take. Yeah, so we'll go through that. So what is the main reason? What's the main reason why Moody finally, this thing is because firstly, there's a few factors. One of them is that they realized that over the past one decade or so, right, the national debt, the US debt has been increasing. And until last year, 2024, right, it has gone up to $36 trillion. And if you don't understand how crazy that is, right, let's take a look on the right side, which is talking about the amount of interest on these debts, right? So if basically what this means is that US is like borrowing money, and by borrowing money, right, they need to return this money, right? So they return this with interest. That's why if they have more debt, they need to pay more interest over time, right? And you can see on the right side is that wow, the interest they have to pay has reached Q1 2025 up to 1.36 trillion, right? So if you don't know how much this is more than, I think, more than 20% of the revenue that the country is making. Okay, so can you imagine you earn $100, you need to straight away give out $20 to your debts and to pay off your interest as a debt. So that's like crazy. Yeah, so what we mentioned, some of people have been saying that Moody, they have bad track record. They didn't help to flag out the subprime crisis in 2008. Yeah, whether we should focus on what they say, not secondary, but the reason why they decided to drop this, right, is mainly because of these two, followed by they say that, oh, wow, the politics landscape in US, right, is quite complex. And until now, after so many years, there's no resolution in terms of how they want to curb or how to treat all these these debt issues, right? And yeah, so coming back again, right? So what is this AAA? What is this AA, right? It's this, right? It's just different tierings, and they've just downgraded one level only. So meaning to say from AAA, they downgrade to AA1. But if you look at here, right, AA1, right, is still on the higher end. It's still of a high quality. It's just that it's now a little bit of risk involved, right? So from minimal risk, now it becomes low risk, right? If you ask me, it's still on the low risk side. But what is the big hoo-ha, right? What is the big hoo-ha? So another thing is that besides this, right, they mentioned that the debt ceiling has been increasing and increasing. And the purpose of the debt ceiling is in the US context or in nation context, right, is to set a limit in terms of how much you can borrow. Right. But time over time again, this ceiling or this limit in terms of how much a country can borrow, just like we have personal credit loans, we only can maximum loan X amount of money, right? If we hit this max, right, we can never borrow more money. But surprisingly, in nation's context, this ceiling keeps increasing and increasing. This is also a big issue, right? Because if this ceiling, right, keep increasing, it means to say the amount of debt they can borrow will continue to increase. That's why you can see like this number or this line keeps increasing over time. right? And if they don't do something about this, together with what Trump wants to do in his term this time around, by having a look, I think Yahoo, I just saw on my phone that Yahoo showed this amount of money that, or these resources that Trump wants to use for different purposes. It is going to put the debt situation on the even higher level. Meaning to say, now I think the debt to their GDP is around 120%, which is overkill already, by the way. Now, with that implementations of whatever Trump wants to do this time around, it's going to increase the ratio, right, to 136 times. So way over what their country is able to produce and export out. So that is something that it was a red flag to Moody at this point of time. So they finally say that, hey, we are going to drop the rating. Yeah. So until this point of time, are you clear about this whole situation? If you are, type in a 1 in the chat. How often do they change the rating? I think it's only depending on if there's a need for a change, then they will update, if I'm not wrong. Yeah. So other than that, they don't know much things about it. Like if nothing changed, need to update. I don't know. So some of them are saying like, yeah. So because of this situation, because of some negative connotations about it, they say that the dollar is going bad, right? It's going down. So is it a good thing? I think for if you're US investors and your rates haven't been that good, your conversion rates haven't been that good, right? Maybe this is a good opportunity to pump in more in US dollars first until when opportunity arises, then you enter using your US dollars. Like when the conversion rate for Sing dollars to ringgit or maybe other or yen, for example, right, was very attractive. A lot of the friends I know were like, wow, it's time to convert more to yen. Then after that, when they convert, what happens next? Or when the time they want to use, they realize that, oh, huh, the conversion went even lower, so even more worth now. Yeah, I shouldn't have. I shouldn't have converted so much. These are some of the common situations that we see, right? Yeah. Anyways, right, so even though they downgraded from AA to AA because of the reasons I just mentioned, they still showed some outlook inside their reports saying that outlook for US actually is still stable. Yes, we downgraded it, but okay, wait, it's not that bad. It's just that those are the reasons why we wanted to downgrade a little bit. But on the other hand, we feel that US economy is still stable. Right now, there's no change in terms of the world currency. It's still used as the reserve currency. Still okay. And on the other side of things, they also stated that the Federal Reserve, the Fed, currently are still not being manipulated by somebody, right? Like Mr. T. And because they are not manipulated and they're still independent, this gives them more assurance or confidence that this should be the way. And if they're not being manipulated, it means to say that Fed is still able to adjust the interest rates and whatnot to curb the inflations and not. In other words, they are still quite okay to do as a nation. So there is not much things to, or no bigger red flags to talk about. Yeah, so I think that's where with this in mind, I think it gives me a bit more confidence when I was reading about this is not really a bad thing. And if you think about it, right, this is just one low tier. And I think when something is on the pedestal, right, something is way up here. Just imagine when you are still studying and you scored like 90+% for a few times for your test. Then suddenly this time round you get 80 points. What will a common Asian parent say? Why this time round you drop your grades? Why this time round you drop your grades? Last time you 90% one. Now you so I think yeah. So I think that's where it's not always good. But anyways, just to rehash, right? So if you have not don't really understand the whole landscape, don't worry because I actually previously talked about this in one of the sessions on that, right, over here, 23rd of April, right? So you can check it out as well. And then where this is where Eric talked about the 1T interest rate is every year, how is it remain high or not. So you can check this out before you do other stuff, like do some homework here first on the 23rd of April, right? So just a while back only. Okay. Yeah, thanks, Eric. Okay. Yeah, another reason why there's some news saying that, oh, this is going to crash the market or not. In fact, it's this one. I saw this one. I was like, wow, this is crazy, man. What do you mean by S&P is going to crash more than 50% with this downgrade? Wow. So when I read this news title, I was like, something bad's happened. Then the emotional side of me will be like triggered. So it's like, wow, is it time to sell? Or time to sell, time to sell. But upon closer inspection and understanding, and also asking my good friend GPT to summarize things for me, because the article is actually quite lengthy, quite Forbes. So anyways, one of that was saying that, one of the reasons is that when this news brought up, right, you see that this graph itself basically is the US government bonds in different number of years. There's like a 2-year bond, there's a 5 years bond, there's a 10 years bond, 20 to 30 years. Right. Why are we looking at the bonds this time around is that bonds in general, where people view it as a very safe asset class, because this is the government bond. And if the government is doing a decent job in managing the economy and whatnot, by right, this is a good tool to use when the interest rates are high. Okay, so that's why recently, can you see that the rates, in fact, interestingly, the long-term bonds, which is usually denoted by the 10 years and above, these are the long-term kind of like investment tools, right? So in other words, when the long-term investment tools are showing a higher yield, a higher rate of return or higher percentage, right? Meaning to say, for the next 30 years, right, you're expecting to get back around 4.957 for if you invest for 20 years, right? So every year you get a close to 5% kind of interest. Good. Close to 5% risk, low risk to risk free lah. It's a good thing, right? It's much better than putting into like REITs or like any dividend companies that give you 5% payout, but this is subjected to the company's profit or the REIT's performance over time or overall, right? So in other words, if you can get a close to 5% interest for the next 20 to 30 years without doing much stuff, this is where investors or people who have a lot of diversification, they'll start to remove from the stocks, from the higher risk products, then they'll go into the lower risk products like this one. Right. That's why when you see that the rates of these low risk products like government bonds or SSBs, right, goes up, money will be moved from one place to another. And when money move out of the stock market, meaning your S&P 500, your US market, your whatever Singapore market, the equity market, basically, when money is being withdrawn, right, the demand drops, right? And when the demand for this, right, when nobody's buying it, people are selling it, right? That's when the share price kind of crash a little bit. So that's why when there's more sellers, the share price usually goes down. Right. So in other words, if the government bond increases their yield, highly likely that people will move money into these classes. Right. So that's why you can see that the share price for your equity side will tend to go down, right? So that is one explanation of what is going to happen, right? But why 50%, right? I think that comes to play when there's a lot of fear in the market, especially like this kind of news where they talk about, wow, it's going to crash, or all the big jargons, all the big fear hook, right, starts to come in to play for emotions, right? And then people start to sell, and then people will start to pull up because they see that, downgrade means not good. Right. So if it's not good, I better find somebody else. I better move out of US. And then they start to liquidate. Same thing, when they start to liquidate, they'll exit out of the US market, and then they'll go to Asia or go in somewhere else outside of the US, causing the market to go down. So far, so good. If you understand this so far, type in a 2 in the chat. Yeah, so I will just summarize this at the end to share my take on it. But before that, right, this one also another big character, big person, not big person, big renowned figure in the investing world, Dalio. Right. So if you don't know him, he is one of the renowned people that is still alive, right? That knows his stuff in the finance market. He's been monitoring it, and then he also has his own like hedge fund to help people invest. Basically, he also came out to say something, right? He says that, yes, the rating kinds of drop is a warning, but actually, did you know that this drop in the ratings, the credit ratings of the US is not fully recognized? Meaning to say, this rating from AA1, right, actually is not the full picture. Because over here, you can see in his Twitter remark is that they don't include things like whether this country that is high in debt, which is US in this case, will print more money to pay their debts. And this has been the case for US for so many years, right? But yes, okay, they realize that they have debt to pay. So from one side, I need to pay the debt, right? So because I'm a nation, I can print money. I print the money, I pay these people. I print the money, pay these people. So my debt is being repaid. But by printing more money, what is happening to the market? What is happening to their money, right? So what this means is that by printing more money, they can pay off their debt. It's good for the nation. That's a good thing. But for the citizens, for the investors, for the people who park their money into the US bonds, which ultimately who is paying off the interest and the bonds owners are holding is the US government. So by paying off using printed money, the value of their amount actually drops, even though they're getting back this 5%, this 6%. Right. So ultimately, let's say I got 50 cents, right? Okay, maybe this is not the best analogy, but imagine I got 50 cents and after 5, 10 years, uh, I need to I'll get back another 50 cents. So I get back two, right? Now got $1. But imagine on the whole pool, right? Instead of $50, right? Now it's become $100. So my $1, the percentage actually drops, right? So in overall, yes, I get back in absolute number, I get back $1. But in terms of the amount I can spend with this $1, right? Maybe you only can spend like 70 cents worth, right? So what this means is that the value of the money drop, which comes back to a little bit deeper. What he's trying to say is also that yes, you can put your money in low risk products, the government bond, but if the government bond ratings drop, means that their likelihood of printing more money to pay you back is higher. So ultimately, it's not a good thing for you, lah. So what I've concluded, what I've understand also my take is that right, firstly, this downgrading of this rating, right, it's not something to be a big it's not supposed to be something that make you very fearful. Yes, the downgrade is there. It's just flagging out that these are some of the warning signs. But on the other hand, this rating drop, right, it's not Moody that caused it. It's somebody else. They are just saying that, oh, with all these studies, we realized that no, they are not considered the lowest risk because a risk can be, in the case of what Ray Dalio mentioned here, that the value kind of drop because they print money. Never a good thing. And on the other hand, the debt situation is not going to be resolved, and likelihood for it to be resolved in the near term is not going to be there. So that's why they decided to do this. But if you think about it, if you still believe or like what this doesn't mean is that US is going down the drain, right? They're just having this situation. Whether they can tide through it, highly likely they will they'll find ways to increase the debt ceiling again, right? So nothing to be fearful about. But more importantly, like as an investor with these informations, I would not go into US bonds. In fact, I don't really invest in bonds myself because firstly, bonds, yes, they give interest for that fixed rates, right? For me, I wanted to reach a goal of, let's say, a higher goal. Let's say my portfolio is 100K right now. I need to reach it to $1 million. If I think of the situation right now that our interest can give me 4 to 5%, how many years or how long does it take for me to grow this 100K to $1 million? If it doesn't reach the goal there, then my take would be that bonds is not a way for me lah, because it doesn't help me to reach my goal. Even though it's risk free, it's guaranteed, but if it doesn't help you to reach your goal, no matter how risk free it is, you need to consider putting some of the portfolio into other places ma. That's why what I'd rather do is to put into places or asset classes that the value of it actually grows over time. So let's say in companies in the whole market, right? Because yes, the share price can be moving, but if we buy into the top 500 companies, right, like for S&P 500, these top 500 companies, firstly, they're profitable because of the requirements to be in this club. Secondly, over time, if they're able to perform, they will remain in this club. And if they perform well, the value of these companies will go up. And when the value goes up, eventually the share price will also go up, right? So what this means is that if I buy into this company right now, I buy into Palantir, I buy into SoFi, as long as they continue to do well in their reports, they continue to gain more customers, gain more revenue, gain more profitability, then this will be a way for this company to grow, right? And when they grow, people will start to be attracted by them because they are safer now, they're profitable, and then the growth rate is good. That's where the share price will naturally follow, right? So that's why for me, as an investor, I rather put into tools, and which is I think similar to what Ray Dalio is trying to hint, right? Is that some places are growing in returns, but the overall value is like depreciating. Right. This is my inference from his message and my take on it. So how do you guys feel? Do you get my key takeaway? If you have my key takeaway, type in a 1 in the chat. Coco is asking, why Ray Dalio don't have rating? Wow. You see what Eric mentioned in the previous above chat. You have a rating, then people will start to follow your rating. Then if your rating just nice, not accurate, or didn't have the chance to predict it before bad things happen, wow, then people will start come to point say, yeah. So I can best not to rate lah, or you rate internally, you don't tell other people. Okay. Okay, yeah. So before we end it off, just want to say that I think on the 19th, which I would say 18th, Nvidia participated in Computex, and because I invested in Nvidia, there's a disclaimer first, so not a recommendation to buy, sell, or hold Nvidia or any companies that I've mentioned or will be mentioning, right? But I will be covering on Nvidia itself about how they are, some of the updates that showed, which made me crystallize and also be more confident about this company, even though, right, some people are saying that is this a bubble, the share price has grown so much, it's time to come down. But on the fundamental level, right, coming back, this company, are they still being able to grow? We will dive into it deeper. Okay. Before that, just want to shout out to our non-Wealth Pulse community members, which is in YouTube. So thank you so much for watching this. Again, if you would like to listen into the Wealth Pulse talking about, or me talking about Nvidia, right, you can always click on the link inside the description box below. It's under the join the community, and then you can get the 1 month free, and then you can hit into the Zoom session right now. Thank you so much for watching, and stay tuned for the next market update next week. Bye bye.